And we are live. Good
Good
morning,
morning.
boys. How are
Morning,
we?
morning.
Really
Good.
good. Chirpy. It's Friday. In a
Coffee's at the
good mood.
ready.
Absolutely.
That's what we
Just rolled
like.
out of bed. Probably been awake about 3 minutes. You know how it is.
You got your
You look
pajamas on
fabulous.
underneath
You
you.
look fabulous.
Yeah, thank you.
Well, it is that time of the month once again for us to do a mid-month mortgage update with some money talks questions.
Yeah, I've been looking forward to this for the last 31 days.
Well, thanks to a little upgrade that we did yesterday on our streaming platform, we're now able to stream in quite a few places. So we're live on, I think, my page, Sanjay's page, the joint page, a lot of the avocado ones, and our YouTube channels as well. So
Nice.
anyone watching live and wants to ask us a question in the comments, we will be answering live. And if you're watching this later on, feel free to put anything in the comments and we will come back to you. So, lots to catch up on, I think, this month. Some quite interesting things have happened. I hear that quite a few of the big lenders are announcing some more rate drops.
It seems to be relentless, and I think every time we come on, we say about how we're just hearing rate drops, and it just seems to be almost never ending.
Yeah.
I said to you yesterday that I had, within the space of about 3 minutes, emails from 3 high street lenders all announcing quite aggressive rate drops. And it just seems to have gone from such a different place to where it was 12 months ago, with mortgage lenders being, ultra super cautious and looking at everything with a fine tooth comb. Suddenly they're slashing their rates, willing to lend, really, really trying to fight each other for a lot of business. And I guess that's just testament to how strong the housing market has stayed as well, is that there's so many transactions going on that mortgage lenders are having to reprice a lot just to stay competitive with each other to get the attention of these buyers that are out there looking.
So what are we looking at now from a headline hook rate, as it were?
So I did a 5-year fixed rate earlier on in the week, with a 40% deposit for under 1%.
What? Under 1% for a 5-year fix?
Under 1% for a 5-year fix, which, given the first mortgage I ever did when I started in mortgages, was a 5-year fixed rate at 7.19%. So that's quite a difference from where we were all those years ago. But yeah, 5-year fixed rate under 1% is madness. And sorry, Ella?
I was going to say, and deposit levels, you said that was with a 40%, obviously.
40%, yeah, but rates are still coming down at all deposit levels. Again, I did a 10% deposit, I think the week before last, and the rate was, early 2s, so 2.2, 2.3, something like that. And given that the 10% deposit equivalent 12 months ago, when pretty much only Nationwide were offering 10% deposit mortgages, was 3.29. So in the space of a year, it's come down a full 1%, and it's not just one lender that's doing that. That's pretty much par for the course, early 2% with a 10% deposit.
They're all just sort of fighting for buyers' attention, I guess.
Yeah, big time.
That's exactly what it is. I read an article yesterday just about predictions on autumn and how autumn's going to look in the housing market. And there's twice as many mortgage rates available to buyers than what there was this time last year. So it is literally just it's a rate war, isn't it? And only in the last week, as Tom said, you've got NatWest, HSBC, Coventry, Accord, Nationwide, all of them have cut rates. Every single one of them cut rates, and it's across all different loan to value tiers as well. So it's not just they're targeting 60% remortgages. This is 95%, 90%, etc. And it's just really, really positive. To give you an example, I was speaking to a guy yesterday, 25% deposit, borrowing at 650,000, interest rates just over 1% for a 2-year fix.
No.
What do you do with that? And I joked with him that I've been saying for the last 8 years or so that rates can only go one way and that's back up again. And every year I've been wrong. They just keep going down.
I
think we're at a good time of year as well. Sorry, Ellen. I think we're at a good time of year where a lot of lenders are keen to hit their end of year targets. And when they see that other lenders are dropping their rates and getting a bit more business in, they're thinking, hold on, we want a bit of that. We want to do some more money before the year's up. So it's a bit like a slippery slope. When one drops, the others are going to drop as well, because they want a piece of that pie and they don't want to be left out. To trying to get as close to their end of year targets as possible. So it's a really good time because you've got a busy market and lenders dropping.
In parallel with that, there's definitely an appetite to lend. You can tell that from the prices, but also from the changes in what lenders are prepared to lend against. I think I can't remember if we did it on a Money Talks with you or whether it was just offline where we were talking about it, but Skipton got back into the 95% market for new build houses.
Yeah.
And now Clydesdale have got back in at 90% on a new build house. And I think it's, Tom, you'll know it's better than me, I think it's 80% on new build flats. But again, a lender going on a new build house where traditionally you need a bigger deposit to be able to do that. Again, it's just opened up more options and more criteria, availability for customers, parallel with that with the rates that they're getting.
Those
95% on a new build.
My turn.
95% on a new build house is pretty much unheard of, isn't it?
Yeah.
So Skipton doing 95. When we're in a market where obviously we all know the C word, but we're in a market that has been struggling because of the C word. So 95% on a new build house is fantastic.
Amazing. And are those kind of 95 and 90% deals, are they limited to first time buyers on new builds or?
No.
That's good. Okay. Well, for anyone that's joined us and is watching live, please feel free to add your comments in, add your questions in, and we will answer them. We have the stamp duty holiday, the second one coming to an end. Have you seen much sort of uplift in the sort of service levels from lenders? I've heard from a few that they're still kind of dragging behind a bit. Have you seen any from them?
I think you've got the traditional lenders that are traditionally very quick, and you've got the slow lenders that are traditionally very slow. And I don't think a lot of that's changed because of the stamp duty holiday. I was thinking about this yesterday, funnily enough, and obviously before the 30th of June, I had every single buyer under the sun telling me, whatever happens, we've got to complete before the 30th of June. We've got to complete. And now the 30th of June has come and gone. I don't think one person has said to me, I need to complete before 30th of September.
Part of me, it does affect certain areas of the market, but I think down south here, it's apartments more than anything. I think other places in the country will be having a very different story of people still kind of rushing to get through that, but I'm not really seeing that either.
No, I certainly nowhere near the level of conversation and demand that there was around the 30th of June.
We've just had a question coming from Sanjay here. So jargon buster. Buyers often ask this and I think get quite confused on the difference actually. Can you explain in layman's terms, if you like, the difference between having an AIP and an actual mortgage offer?
Sure. Adam, do you want me to take that one?
By all means.
Okay, so AIP stands for Agreement in Principle, and that is sort of a very basic, glorified credit search and affordability. So it's essentially either you or your mortgage broker will put in some basic details into a lender's application system. So normally full name, date of birth, address history, income, and debt. And the mortgage lender will, first of all, do a very basic, usually a soft credit check, which doesn't appear on your credit file. Not all lenders do that, but normally they do a soft credit search and also a basic affordability test. So they'll apply their sort of affordability model and spit out a figure that you can borrow. So the important thing to note with an agreement in principle is that they haven't checked what you've said is true. So you could put into that figure that you earn £500,000 a year, and they'll give you a wonderful, massive agreement in principle, probably for around about £2 million. Great news. You can go and buy a house for £2 million. Obviously, that's not going to stack up, when you get to a full mortgage application stage and the lender says, actually, you earn £30,000 a year, not £500,000 a year. So a mortgage offer will only come after your lender has assessed your income documents, assessed normally your bank statements, and assessed the property that you're looking to buy. So I always say, when you do a mortgage application, the mortgage lender is looking to do two things. They're looking to agree to lend to you, and they're looking to agree to lend on the property. So lending to you is, pay slips, bank statements, employment references if needs be, to make sure that your income is safe and secure and they're happy to take your income. And then also to look at the property, make sure the property is worth what you're paying for it, make sure that it's safe for you to live in, there's going to be no massive problems after you move in. And then a mortgage offer is essentially the offer of a mortgage that you can have, that is valid for normally 6 months. Some lenders are slightly longer, some lenders are slightly shorter. And then that offer will be ready for you. You don't need to do anything else. It's there for when you need it, for when your solicitors are ready to take you through towards exchange and completion.
And also, ultimately, we get some buyers who will sort of, when we're booking them for a viewing, who say they've got their mortgage offer ready. In actual fact, they've got their agreement in principle, and you can't get a formal mortgage offer until you've actually found a house and started with the buying process.
The majority of cases, you'll be absolutely right. Every now and again, you'll come across somebody who's got a mortgage offer and their previous property fell through. So they have got that little bit further, but 99% of the times an agreement in principle is all that customer's going to have. Agreement in principles are good. They're as far as you can get without having an offer accepted and without finding a property. But the distinction between the two, scrutiny, no underwriters looked at it, no secondary or tertiary questions have been asked, and it only gets you so far.
Right. So here's one for you then, Adam. Would you advise a family to remortgage and lock in for 5 years, considering all the great rates that we have just talked about?
It completely depends. I'm going to have to dodge the question a little bit and kind of tiptoe around it, but it depends on the case-by-case basis, doesn't it? Traditionally, would I recommend a family to remortgage and lock in for 5 years with great rates? Yeah, of course. However, not if that family's looking to move in 2 years because their kids are moving to university and they're going to downsize. Not if they know, they've got other plans. If you just go after the rates, that's great, but you also need to think about your situation and whether it's right to do so. I do speak to lots of people who have secured in for long-term fixed. In fact, I'm speaking to somebody at the moment who fixed in for a 5-year fixed rate, is now looking to raise a bit of extra money, and the rate that he can get is nearly half of what he's fixed into. So he's thinking about, do I pay the early repayment charge, come out fixing on an even lower rate for another 5 years? Maybe not completely cost effective to do so, but it's not always about just locking in for as long as possible. Speaking to another customer yesterday who gets big lump sum bonuses, I defaulted to say, well, I assume you want to fix in for a 5-year fixed rate because you're putting in a great big deposit and you're buying a big 4-bed property. He said, well, no, because I've got these bonuses coming in. I thought, yeah, good point. Actually do a short 2-year deal. And then what you can do is pay down your capital, maybe then do another 2, 3, 4, 5-year deal, whatever comes at the time. But it's case by case. Traditionally, yes, it sounds great, but it's case by case.
Fair enough. Okay. And I guess, that's one of the other reasons, as we always talk about, why it's so beneficial to go to independent whole market brokers like yourselves, as opposed to just speaking with their bank, who are going to give them one opinion and one opinion only, really. At least you guys can advise and tailor things to whoever needs it.
Yeah, I think that's the key point. I think you'll often find that banks will order take very much. So you'll walk in and to whatever bank, say, right, I want a 25-year term, a 5-year fixed rate, almost like you're in the tills at Tesco. There you go, sir. There's your mortgage. When actually, it's much more beneficial to have a conversation around, right, what's the right term to take, what's the right fixed rate to take, because as Adam mentioned, there's no correct answer, because everyone's situation is different. And I 100% agree with what Adam said, that theoretically, yes, whilst the rates are crazy low, doing a 5-year fixed rate for a family is more often than not going to be the right thing to do. But if they're looking to move in 2 years' time, or they want to get into a school catchment area in 3-4 years' time because they've just had a baby, then maybe having a 5-year fixed rate isn't the right thing to do, because they might find they're going to be stuck in and not able to move to where they want to.
Tailor make it. Not any two situations are ever the same. So
absolutely, that's why we enjoy the job we do so much, because everyone's different, everyone's situation is different, and every situation does pose individual challenges, and yeah, we enjoy getting over them.
Yeah.
The day that's not the case is the day we're out of a job, let's be honest.
One thing you and I talked about briefly yesterday, Thomas Brown, was lending criteria. Sort of pre-COVID, post-COVID seems to be the new time frames that we live in. So kind of,
yeah.
Where are we?
So I think the main difference is around additional income. So when I say additional income, I generally mean bonus, commission, and overtime.
Yeah.
Sort of March last year, the majority of lenders just stopped accepting it, full stop. No matter who you were, how consistent it was, they weren't going to take bonus, commission, overtime, because who the heck knew what was going to happen with employment and jobs, and any employer was potentially in trouble. So we've seen over the last 3-4 months, nationwide have come back to accepting bonus, commission, overtime, whereas they stopped accepting it at all, I believe, unless you worked in the NHS. So now they're accepting it for everyone. Halifax, they reduced to accepting only 30% of bonus, commission, overtime. Historically, always they were 60%. I think about 3 weeks ago, 2-3 weeks ago, they went back to 60% of bonus, overtime, commission, which is the same as pre-COVID. And there are lots of lenders who are 100%, 50%, wherever they were before the pandemic, now back to where they were again. So it's really positive to see that we're getting back to where we were, because you know what, a lot of people do rely on those extra incomes to be able to afford the mortgage that they need, especially in the area that we live. You know, people do rely on that extra income, and being able to find a lender who can accept it, and you know, when a client can clearly demonstrate it, is really, really important. So it's good to see we're back to where we were.
Good. Well, that makes it easier for a lot of people in sales industries and whatnot. So
yeah, you know, that was crazy. You know, March, April, May last year, when you know the conversations that I was having were you know, people, like you said, in sales jobs, where normally they get a fairly modest basic and then made up with the rest with commission or overtime. You know, they're expecting to borrow 400,000 and they might only be able to borrow 100,000. So yeah, good to see we're back to where we were.
Yes, all positive on that front, which is good. We have a property on the market at the moment. It's an apartment, and so it's obviously leasehold. Now, we've previously talked about lease length and how low is too low. And I've done a blog on this as well, which I will post in the comments for people. This particular property's got 89 years. And I speak to a few people who their knee-jerk reaction is that's too low. And I'm sort of trying to establish why it's too low, because as we know, lending isn't a problem at that level. And if they're thinking of selling even in 5 years' time, lending still isn't a problem. You know, they've almost got the best part of 20 years there before that's an issue. Where does that kind of lease lengths and lenders, what is kind of the minimum? Where does it sort of get a bit hairy?
So I would say probably as an average, most lenders want over 70 years. Santander will do as low as 55 years. I think they're one of the lowest in the market. They'll do a 55-year term, as long as they're 55-year lease, as long as there's 25 years left at the end of the mortgage term. So if you buy a property with a 56-year lease and take a 25-year mortgage term, there'll be 31 years left at the end of the term, and they'd be happy with that. But for most lenders, 70 years is about par for the course. But 89 years, I can't think of a lender that has a problem with 89 years. As far as I know, every lender in the country would be fine with that.
I think lots of customers often, as soon as you get below 100, there's just something psychological where they think problem with the lease, and it's It's just not the case.
Everyone's going to live forever,
Yeah.
Adam. You forget that.
Yeah.
Everyone's going to live forever.
But I think equally, it's equally important to remember that leases get extended. They don't just go down to 0. I mean, it's quite common practice that you're going to extend the lease and it's going to become longer again, which, if anything, can actually add value to the property if that person does that and then goes to sell it again. So there's an opportunity there at the same time.
Yeah, it's interesting you say about the dropping below 100 years, because sometimes they're only built with 99. So,
fun enough, my dad's selling a flat at the moment, and it's got an 86-year lease. I think so. Very very similar. And he lost 3 buyers throughout the process. He's now exchanging today to a great buyer. But the similar problems were with the lease. There seems to be some sort of mental block in people's heads in regards to getting under 100 years. I agree. But he's really good news. He was going to exchange today to a really, really nice first-time buyer who lives in the development already. So he's chuffed.
Oh, well, congratulations, Mr. Brown Senior, on your exchange today. Okay. I mean, we're coming up to, we've just gone over 20 minutes. As I said, we'll put some info in the comments about those lease lengths, because that is a question that comes up time and time again. If you're watching this later, pop a question in the comments for us and we will come back to you. But I think that pretty much has run through everything that I wanted to. Any other final words of wisdom, gents?
All good. Covered all the points I wanted to go over. Rates, we can't keep saying it. Rates so low. It's almost unbelievable. So now is a great time to purchase, remortgage, think about moving. It's really good time.
Good time to get a move on.
Nothing else to add from me. Exactly
Excellent. That. Good. Okay. Well, 28 days will pass and we will be here once again.
It'll be almost Halloween.
Ooh,
that's crazy.
Maybe we'll do some
Spooky.
sort of. Maybe we'll be pumpkin property or something instead. You never know.
I don't know if dressing up I can stomach that.
We'll run a little pumpkin carving competition instead for us all.
Oh, we'll have it on our heads. Guess who's who?
Yeah. Amazing. Well, thanks everyone for watching and getting involved. Tom, Adam, have a great day.
Nice to see you, Ellen. Have a good weekend.
Happy Friday, people.